Hello, everybody. Thank you for joining us. Please bear with us a couple more minutes. We have some people who are trying to connect and would like to give them that opportunity. Thank you very much. Bye. Hello, everyone, again, and thank you for joining us. We'll be starting in exactly 1 minute. Thank you. Hello, everybody. This is Fraj. I'm delighted to be with you again one more time, and I hope we can be with you every month till at least the end of the year, and then we'll be scheduling a few different things next year. Today's subject is factor investing. Many of you before have asked us. Many before have in surveys that we made in the past, everybody was interested in asset allocation. And that seems to be, that was a buzzword back in the 90s, if you remember, those of you who have been in business long enough. Things have evolved and changed, and the buzzword today is factor investing. In many ways, it's not a lot different than asset allocation. In many other ways, it's different because of the dynamics that factor investing brings in. Let's start with a little bit of discussion as to what is factor investing. Basically, there are descriptions or characteristic of associated with equities that are again connected with premium returns or high returns. In other words, if the right combination at the right time takes place with intelligent construction, then the investor and the advisor should end up with better returns than at least the S&P 500. Let's see what are the most common factors used in the industry. You all know what the word value means. You all know what the word momentum means. What used to be, value versus growth is now value and not versus, but and momentum combinations. Quality is something that is very subjective, regardless what industry you're in, and particularly ours, because everybody defines quality in a different way and use different definitions of it. But the end result is whatever you, the investor or the advisor or the manager, decide to put in the recipes of what quality is in the securities that they have, as long as they meet their objectives, as long as they meet their goals, there will be that kind of quality that they're looking for. Somebody who's chasing high yield bonds, to them a high yield bond quality is the one that pays the highest interest, while the other side to the coin for somebody else that is a little more conservative and a little more careful, that may not be a quality. Sector rotation is another factor. Now, there are almost as many factors as there are investments in the world, but what we're talking about are the ones that are used most by most institutions, most professionals, and the ones that make more sense to all of us. Sector rotation has always been associated with returns also, based on the timing of the sector or the security, not the timing of the market. So if you do it at the right time with the right combinations and the right changes at the right time, yes, you can end up in a positive position. The same thing with cap size, small cap, mid cap, large cap. It's a factor, international investing. And within it, and by the way, inside each one of these factors, there are a multitude of sub that when you do the research and the study, you have to look at. And we're not going to get into that, but we're open to your questions and we're open to your comments. And we're open to suggestion if you need to know some of those things in the future. We'll be more than glad to present them individually, because otherwise we'll be here sitting here for a week trying to make this presentation. Credit, which is credit rating, or of a specific company, or the size of credit, or the size of debt to assets, the size of debts to equities. Those are important factors that help you determine whether to buy, to sell, or not to get involved at all in any specific security. Factor investing is inherent to active investing. You cannot decide on factors and choose them forever. I mean, there are situations where you may hold on to a certain factor in your decision process, and that factor could be good for 10 years. Other times it could be good for a year or two, depending on when did you time your decision to use that factor in making your investment selections. The reason also it's considered an active form of investing is that, well, just because you made your factor selection, you don't go to sleep and think everything will work out. You have to have continuous decision-making process and evaluating to stick to specific factor, to modify them, to increase them in your portfolios or models, or decrease them, or totally get out completely. The same thing in determining what the ratios are. You may decide to use a specific factor to the tune of maybe 10% or less of your portfolio, or maybe you want to use a little bit more, depending on what type of portfolio you're managing. If it's conservative, if it's aggressive, if it's ultra conservative, if it's super aggressive. timing, in time, that is not timing the market, but in time, decisions that you have to make in a timely manner, whether I'm going to be with using the factor for the next 2, 3 years or 10 years or less. And that timing is a lot of time is determined by the goals or the objectives of the portfolio that you're managing, or the investor's time horizon, and that determines also what type of factors you're going to use to construct portfolios for the investors based on time horizon. Balancing costs, or as we call it in our end of the business, is the need for adjustments. We have a lot of companies that do balancing and rebalancing on a quarterly basis, on a semi-annual basis. From the inception of the Investor Advantage, and even before that, going back to the late 80s, our balancing or time for adjustments is not based on a calendar, because we believe that the markets don't work on a calendar basis, but it's based on variables or variations in the values of the selected securities that we have. So we may include one security, exclude it, reduce it, increase it. That's our type of balancing and adjustment versus, at the end of the quarter, I'll move out of some and move into others. We have to go by percentage appreciation or depreciation in the values of securities that help us determine whether, if my objective is to gain 30% out of an investment and I'm at 20-25%, the evaluation and the monitoring becomes more intense, versus if I have something that I have a 5-year objective for, I may not be too concerned for the first year or two, but then as it gets closer, we take closer looks. Now, when I say not too concerned, it doesn't mean it's not being monitored, but we take into account the variations that particular security may have, based on its history and based on its, again, on its future and what its performance is before we make quick decisions on it. Other factors that are, for some people, considered less important, but we consider them extremely important, is liquidity. And liquidity is important in two aspects. Liquidity based on the need of the investor. If we're managing a retirement plan and there is certain number of the employees that is approaching retirement, a certain amount of liquidity is needed. If we're managing for an individual and that individual may have some liquidity needs in the near future, that becomes important. We have to take into consideration. But also, from our standpoint, when we're managing portfolios, liquidity is extremely important, as what we call cash in the portfolio, or something that could be quickly converted into cash, like a very short-term exchange traded fund, bond holding, where we may just use it to enhance a little bit of the return that the cash is not giving us. But we're going to need those funds for some opportunities, and we need that type of liquidity. Is what I call the dry ammunition that you may need to fire with when the time is right. Trading cost. Now this you have seen, for example, we have, under the influence, we have put on pressure to put on Money Concepts to negotiate more and more to reduce the costs of trading with Pershing, and we've been successful so far. Some of you have been long enough to remember that the trading costs for a mutual fund of our stock was over $20, and we're now at $6 or so for the mutual funds, and $8 and maybe some cents for the equities. That's a big progress. And trading cost has become very important in the last couple of years, and you'll see this repeated a little bit later. Is due to two things: Vanguard and the reduction of costs, and the automation of investments, and sometimes even in investment advice, even though I wouldn't call that advice, in terms of allocation of resources into specific securities on automatic basis, reducing the cost to the investor. In addition to that, the competition that we all live with is dictating a reduction in the cost. About 10 years ago, I was making a presentation to our associates, and I said, gather as much in assets as you can today, because 10 years from now, the competition will be on the price, meaning the cost of managing the assets. Those of you who have been here long enough, remember the 8.5% load on mutual funds. You can't find one that does that today. And many of the mutual fund companies themselves are shifting, as you know, some of their business into the exchange traded funds, and that was dictated by the cost structure. In addition to the transparency, the tracking of the index based on a very negligible margin, those things became important. Factor investing is for diversification, or is a form of diversification. When we used to talk about asset allocation, we talked about bonds, we talked about stocks. That's under the efficient frontier scenario. The investor's advantage uses the essential frontier, which is an improvement on the efficient frontier by adding some of the factors that were included in some of the endowment funds by the major universities like Harvard and Yale and Cornell and Princeton and all that. They had a structure in their portfolio that included real estate as an alternative investment, other alternative investments, small cap, mid cap, and international investments that the efficient frontier does not take into account. And that's basically defined as the essential frontier. By adding more diversification, you reduce the volatility, reduce the cost, and they were able to construct what's called absolute return portfolios. And we modeled our original system based on the essential frontier, and we didn't use the term factors back in the 80s and the early 90s. We talked about asset allocation, we talked about diversification. The major difference between using factor versus using, for example, the term asset allocation is the amount of information and liquidity that turned the decision into a very dynamic decision. Factors, no matter which one you choose, the information flow is much more readily precise and available to the advisor and to the manager. That typically, especially the old days asset allocation type, you may allocate to a certain asset that doesn't give you the valuations on a minute-by-minute basis. And the advent of the exchange traded funds, which, by the way, the investor's advantage is the pioneer of the usage of exchange traded funds in the managed accounts. Prior to that was just some institutional block trades, and we included them being aware of the cost factors, being aware of the diversification factors, being aware of the precision that you need to have by allocating into an exchange traded funds that does not deviate, that doesn't have overlap like a mutual fund does, and at a much lower cost and more transparency. So that was part of what we dealt with. It is a common sense defensive set of strategy that you can use based on the flexibilities that the factors give you and the transparency in cost, in return, in fluctuation, in volatility, and much more in a much more predictable way based on more scientific factors than you could use just using term asset allocation. The IEP, the Investor's Advantage Portfolio, as I said earlier, we didn't use the word factor investing. We used diversification and asset allocation like everybody else. But what we actually did was, in fact, factor investing all these years, and the name is catching up with the practice. Using the essential portfolio approach is in itself a form of discipline that is based on factors. Investor protection in times of drawdown. factors help you with that. Those of you who have been doing business with us long enough know that your clients could sleep very well in 2008 and early 2009, and that's because of the approach that we use in investing, and the factors that take into account the factors that include, by the way, geo-global impact. Those are factors, and we had that at our fingertips those days, and we were able to protect the assets. Selection and rebalancing based on valuations, not calendar, which is what I mentioned earlier. Timing sectors and securities rather than timing the market, meaning if my macro approach, top-down analysis that indicates to me what sectors, what industries are going to be the ones to be in the next few years, we will select from those sectors. That's one step, and then from there, in other words, that is timing the sectors, and after that, timing the securities within those sectors and reverting back to bottom-up analysis on a fundamental basis, so that we are in the right place at the right time with the right securities on the right path for growth and value for our clients. Being active and having discipline is what the Investor's Advantage all about. From a historical perspective, it was created to diversify, to reduce costs, to mitigate risk, and a disciplined approach from the selection to the disposition of any security. In other words, we don't just, oh, it's going to be good, buy it. Oh, it's bad, sell it. Why is it going to be good? How does it compare to the competition? What time is it to select it, and what time is it to buy it? Just because a security is good, it's going to look good, it doesn't mean the timing to buy it is that time. It may give you a better opportunity if you waited a little bit longer based on the factors that we're looking at for that specific industry, company, or sector. The same thing when we dispose of it. Sometimes we may hold on to something, sometimes we may reduce it, sometimes we may sell it totally. There's certain things that have to do with time horizon. I'll give you an example. We had GE, and everybody knows the doldrums that GE is going through. Long term, that company is still going to be around. It's going to be stronger than it is today, and it's going to be bigger than what it's going to be in the next 2 years, because it's going to shrink by selling some of its assets and some of the businesses it's in. But the business that it will remain in is where their strength is and where the future is for GE and many industries. So if you have a long-term horizon, it's not a bad thing to have in your portfolio. Again, important in the discipline of the factor is the time horizon that helps determine what to invest in. Somebody that can stay away from the money for a 10-year period, for example, will do very well in the Alpha 1 or the Alpha 2 models, because those models are designed to give results over that period of time. It doesn't mean they don't give results in the immediate future, because our philosophy is you cannot make money long term if you lose it on a short term basis. You have to always protect the assets while your eyes are on the prize down the road a piece when you make selection of the security, so that you get the full benefit of the security to selection. Being goal-oriented or objective-oriented. The portfolios are goal and objective-oriented, and we designed them, the Investor's Advantage portfolios, that's why we have so many models, because they match the needs of every investor from any stage of life, while they're in the accumulation phase and the growth phase, or the income phase at the time of retirement, where they need to draw on the assets with protections during the drawdowns. The consistency of the process from peak to trough is is extremely important, and that's a form of discipline that most people don't adhere to. They go with the wind, up or down, and they make their movements just because of that. You may make partial movements, but you still have to evaluate the individual securities in the process so that you're not dragged down by the market. We always say we're not investing in the market, we're investing in individual securities that may get impacted by the market. I want to bring something to your attention that a lot of people in the factor investing have been doing, and say, okay, why don't we just go into an index? Well, indexing by itself alone, without management, being totally passive, is really a form of concentration. You have just a few companies, exactly a handful of companies in front of you right there, and look at the percentages that they represent out of the S&P 500. We were having a conversation earlier about Amazon. Amazon is 25% of the S&P 25% of the S&P 500. So if you put $1,000 in the S&P 500, that 25% of your money is concentrated in one holding. Apple is a little less than 20%. Netflix is almost 10%. Google slightly less than that, and Facebook slightly less than that. So if you put your money in the S&P 500, you have to total to say 8, 9, that's 17, plus 18, that's 35, plus 25, that's 50, and then about another 4%. So about 54 to 55% of your investment, when you put them in the S&P 500 as an index, are in these 5 securities. Well, the rule of thumb that we use in investing is I do not wish to see one holding decline enough to make my portfolio, have a serious drawdown. And if you look at all the portfolio models that we have, our allocation is always somewhere between 2 and 4%. And a couple of times throughout the years, we allocated about 6% to the tips for at the right time, and we made some money on that. And the reason behind it is it's one additional measure in diversifying your portfolio that you can help protect the assets in the drawdown, because the drawdown of one company can bring you down drastically if you don't pay attention to it. They're not little things, but important things like this. Okay. Another thing that we want to bring to your attention, you hear a lot of talk about how the value really didn't do very well in the last decade. The white line represents the broad S&P 500. The blue line represents the value part of the S&P 500. And the facts are the facts are the facts. And we are in the fact-based investing. That's why we did not exit value completely. We have many of our portfolios are value investing. Obviously, the aggressive, the Alpha 1 and Alpha 2 are considered momentum factor-based, but they're not devoid from value securities in there because we believe in balancing things correctly. Well, guess what? Value securities, when you look at this graph, didn't do bad at all over the last 10 years or so. So keep that in mind so that you don't get carried away by what you hear, get carried away by what you actually check as facts. Another thing is that has never changed in the stock market business. What drives values is earnings. Here's an example where the oil companies, the energy companies have been on the skid for quite a while, but look what happened from March of last year till now in terms of profit and in terms of dividends and in terms of contribution to the value and the growth of security. So there's certain factors. We call this a factor ourselves. Revenue and cash, earnings are factors that most of the industry has not considered them as factors. They consider them in the evaluation, but they're not considered them as part of the factor investing business. I know in such a short time, I put a lot of stuff on your hands. We are always available to answer any questions that you have now or you may have later. You can always also visit the Investors Advantage Portfolios as the investorsadvantageportfolios.com, the password, and this is for you, the advisors. That's not for the client. Not everything, the client can access the website, but anything that's under the password is for broker, dealer, and advisor use only. So please don't give that password to your clients. You can extract the information from there and share it with them, but you can't let them go into the website or you can call us at 888-PLAN, PLAN 111. You can ask for me, you can ask for Nancy, any of the other team members that will be able to help you with any of the needs that you might have. And as always, we are still, we'll continue to offer not just still the advisor success track to help you improve your book of business in a very factual, effective, and professional way so that you can grow your business, especially on the fee income basis. And I thank you very much for being with us. I look forward to meeting with you again the next time. I especially look forward to seeing as many of you as possible at the conference, where it seems like they're going to give us a platform for 20 minutes to speak. And ideally, I would like to have it as a question and answer scenario. So if you have any question, also you can bring them at that point in time. And thank you very much. Unless you have, if anybody has any questions right now, you can text them to us, or you can always call us or email us as previously indicated. I'm going to give it a couple of minutes to see if anybody has any questions. If not, we'll depart. Okay. You can type the questions in the question and answer section, and we'll answer them if they come in.
Did you give the password?
Hmm?
For the website?
Yeah, again, the password is right there on the screen in front of you. We protect. One word, we protect. That's the password when you access the investorsadvantageportfolios.com and you want to access the advisor section. It doesn't seem like we have any questions today. I thank you very much for joining us, and I wish you all the best of health and a great summer. Take good care. Bye.